All right, let's talk about Palantir because what's happening right now is just fascinating. On one side, you have this perfectly logical, really powerful argument from one of the world's most famous investors. And on the other side, a set of earnings numbers that are just completely off the charts. It's a total clash of titans. So, let's dive in. So the whole bear case, it really boils down to this one simple idea from Michael Burry, the guy from The Big Short. His argument is that Palantir built its entire empire, its whole premium price tag, on the idea that high-end AI is this super rare, super expensive thing. But then, boom, this new AI model called DeepSeek comes out of China, and it threatens to turn that rare resource into a cheap, everyday commodity. And when you hear that, you've got to think game over, right? I mean, if the very foundation of your business is about to get commoditized, the story's pretty much done. At least that's what made sense to a lot of people. Until it didn't. And then this number just hits the tape. 137%. That is their year-over-year growth in the U.S. commercial business. Now, that does not sound like a company whose core value is collapsing. That sounds like a company hitting the afterburners. And just like that, the simple, logical story got really, really messy. Okay, so here's how we're going to break this all down. We'll start with that seemingly flawless bear thesis. Then we'll look at the numbers that just don't lie. We'll dig into why the thesis has stalled out, see who else might be caught in the crossfire, take a quick history lesson, and then we'll wrap it all up with a watch list for you to keep an eye on. Okay. First up, the flawless bear thesis. Let's really get into why one of the world's most famous investors is betting against Palantir. And you gotta understand, this isn't really about Palantir's specific software. No, it's bigger than that. It's about the entire AI market getting turned on its head. Okay, so this is the bombshell. The market's even got a name for it, the China discount. Look at this, a premium AI model like Claude 3.5 Sonnet that'll run you about $15 per million tokens. Now look at this new model, DeepSeek V4. It costs 14 cents for the same amount. I mean, let that sink in. That's not a small difference. It's over 100 times cheaper for basically the same result. That's not just a crack in the wall, that's a cannonball right through a main gate. And here's the key thing to get about Burry's play. He is not trying to time a bad earnings report. This is not a short-term bet. He bought options that don't even expire until 2027. He's playing the long game. He thinks that over the next few years, this huge price gap is going to slowly but surely chip away at what Palantir can charge its customers, and that eventually the whole company will have to be valued differently. All right, so that's the bear case, but now we get to the other side of the ring. Because Palantir's response to all this, well, it wasn't some fancy press release. It was just their earnings report. And man, did it tell a different story. And this is exactly where that perfect bear thesis just smacks right into a brick wall. Just look at this. They put up 137% growth in their U.S. commercial business year over year. And they're not saying it was a one-time thing. Nope, they're guiding for 115% growth next year in that same business, and 61% for the entire company. I mean, come on. This is not a company on life support. This is a company in the middle of a world record sprint. But, and this is a huge but, you're paying a massive premium for that growth. Palantir is trading at almost 68 times its forward sales. To give you some context, just look at these other top-tier tech companies. CrowdStrike, Snowflake, they look like bargains by comparison. Even a monster like Microsoft is only at 12 times sales. So that giant gap between Palantir and everyone else, that's the whole bet. Burry is saying that premium is going to disappear. So we've got this incredible tug-of-war, right? A super logical, long-term threat on one side, and these insane short-term numbers on the other. So the big question is, why has the thesis stalled? What's stopping it from happening now? Let's dig into that. Well, it seems to come down to two really powerful forces. The first one is what people call enterprise stickiness, and it's exactly what it sounds like. Once a giant company gets Palantir software tangled up in everything they do, it is an absolute nightmare to switch. We're talking incredibly difficult and expensive. And the data shows that about 90% of companies just stick with the one AI provider they pick. Then there's this other kind of counterintuitive idea, the Jevons paradox. Basically, when something gets way cheaper, you'd think we'd spend less on it, right? But what actually happens is we just find more ways to use it. Think about it. Cars got better on gas, so people just started driving more. Same thing's happening with AI. As it gets cheaper, companies are like, great, what else can we throw this at? And that just expands the whole market for everyone, including Palantir. But here's the thing, those forces, they're just buying time, because the underlying pressure from that collapsing cost, It's not going away. In fact, it's accelerating. Check out this number. In just 1 year, the cost to hit a top score on a major AI benchmark dropped by 99.7%. So we're not talking about things getting a little bit cheaper. We're talking about the bottom completely falling out of the price.
And, this isn't just a Palantir story. That's what's so important to realize. This risk, this potential for contagion, it could easily spread to a whole bunch of other AI darlings too.
I mean, just look at a company like Snowflake. They sell a pricey, premium data platform for AI. But even their own CEO is on the record saying that these cheaper, open-source models are a real threat. And then you have a company like C3.ai. You can almost think of them as the canary and the coal mine. They're a bit like Palantir, but they don't have those big, stable government contracts to fall back on. And guess what? They consistently lose money. It shows you what can happen when you don't have that safety net. So to really wrap our heads around what could happen here, we actually have a great history lesson we can look back on. Let's rewind the clock a bit to the 2010s and what happened during the big enterprise software wars. This chart tells the whole story. This is SAP, who were an absolute beast in enterprise software back in the day. Now, when cloud computing came along, SAP's business didn't fall apart. It actually kept growing. But look what happened to its valuation, its price-to-sales ratio. It got chopped in half. So even though the business was doing fine, the stock went absolutely nowhere for years. This is a classic case of what Wall Street calls multiple compression. And that idea, multiple compression, is the absolute heart of Michael Burry's bet. He doesn't need Palantir to go out of business to win. The company could keep growing sales like crazy, but if that sky-high valuation, that 67 times sales number, just comes back down to earth, say to 20 or even 30, the stock price could get crushed, even while the business itself is doing great. That's the scenario. The business wins, but the stock loses. Okay, so that brings us to the big practical question. How will we know if or when the tide is actually turning? Let's put together a watch list of 6 key things you need to look out for in Palantir's future reports. First up, you've got to watch that U.S. commercial growth rate. Of course, it's going to slow down from 137%. But the question is, how fast does it slow? Second, look for something called net dollar retention. It's a simple idea. Are your current customers spending more with you over time? And honestly, the fact that Palantir doesn't even report this, that's a bit of a yellow flag right there. And third, look at the deals themselves. Are they still closing those giant, big money contracts? Or is the growth starting to come from lots of smaller, more price-sensitive deals? All right, next are a few things that are a little more subtle. You have to listen to the language they use on their earnings calls. If you start hearing phrases like competitive dynamics, that's usually corporate speak for we're getting squeezed on price. Also, watch the conversion rate for their AIP boot camps. These are basically their big sales pitches. If the number of companies signing up after these boot camps starts to drop, that's a major red flag for future sales. And last, look at their international business. Is all this crazy growth just happening in the US? If so, that could be a problem. And just so we're all clear on how Burry is actually placing this bet, he's using something called a put option. The easiest way to think about it is like an insurance policy on the stock. He pays a fee today for the right to sell Palantir shares at a specific price, way out in 2027. If this stock drops below that price by then, he makes money. He's literally paying for time, just waiting for his long-term thesis to come true. So, when you boil it all down, here's where we are. The bulls have the numbers right here, right now. The bears have this really compelling long-term logic on their side. Palantir's explosive growth is buying it a lot of time. But that clock, it's ticking. And that's why the ultimate question here isn't really, is Michael Burry right? The real question is, will he be right before 2027? And that, right there, is the multi-billion-dollar question.